The success of a firm depends critically on its choice of legal structure in the dynamic commercial world. Limited liability partnerships, LLP, and traditional partnerships are two frequently used choices that catch the attention of business owners. Before making a decision, it is advisable to speak with legal and financial experts because it could have substantial legal, financial, and operational repercussions. A company structure called an LLP combines aspects of partnerships and corporations. It offers its partners limited liability, which shields their private assets from company debts and responsibilities. And partnership are not held personally liable for the deeds or activities of their other partners. Partners in a partnership split the company's gains, losses, and managerial duties. Partners' assets are at stake due to their unlimited personal accountability for the business's debts and obligations. Partners in AR are protected from personal obligations by limited liability, which limits their exposure to financial loss. LLPs must formally register with the relevant governmental agency, whereas partnerships frequently do not, depending on local legislation. Like a corporation, LLPs offer greater management and governance structure flexibility. Usually, a partnership has a more straightforward management structure, and partnerships are both commonly pass-through entities for tax purposes, which means that income and losses are transferred to the tax returns of the individual partners. Limited liability partnerships, LLP and partnership, have distinct legal requirements. Typically, forming an LLP entails registering with the proper government agency, which may differ by jurisdiction. Formation of a general partnership is possible without official registration. A more adaptable management structure is typical of LLPs. In an LLP, partners have limited responsibility, which means that the company's debts and obligations normally do not affect their assets. In a general partnership, each member is personally liable for all debts and liabilities of the business. Profits from LLPs are often taxed at the partner level because they are typically treated as pass-through entities. Partnership deed. Create a partnership deed defining the partnership's rules and conditions, including stamp duty. Execute the partnership deed on non-judicial stamp paper. The sum varies from state to state. Registration, optional. Registration for partnerships is optional but advised. PAN and TAN. Obtain a permanent account number, PAN, and tax deduction bank account. Open a bank account in the name of the partnership using the PAN and TAN. GST registration if applicable. Register for the goods and services tax, GST, if the partnership firm. Business owners must carefully consider their options when deciding between a limited liability partnership, LLP, and a conventional partnership. LLPs offer a considerable benefit in terms of limited liability, safeguarding participants' private assets from corporate debts and obligations. However, while partnerships are flexible and simple, they also subject partners to unrestricted personal liability.